Happy Sunday, guys. Welcome back for what is going to be nothing short of another jam-packed daily market update where we like to cover all the latest and greatest things happening within the cryptocurrency space, but also the broader markets. And actually today we are going to be focusing predominantly on broader markets and economies. Certainly the US economy and the two camps that you're either in right now and you should essentially be taking a position as a result of. We're really going to simplify that. You're either in this camp that you think, actually, we've got a good time ahead of us for the economy. So we've got some sort of a boom coming, and that could be that 2017 style scenario that I'm personally expecting. Or you're in the camp that we're actually going to enter a recession and a downturn in the economy, and thus markets aren't going to do very well on the back end of all that. And I think with a lot of what's taking place with tariffs, with cuts to government spending, with continued economic data coming in, there's a rebalancing taking place in regards to probabilities of both or either one of these scenarios taking place. And actually with the worsening economic data, the tariffs, the uncertainty, it's probably more swinging towards, not in terms of having a higher percent, but an increased percent based on where it was a couple of months ago towards that recessionary scenario. Now, I'm not in the recessionary camp, but if the probabilities of that are increasing based on data and uncertainty, what you're essentially going to see is hedging, sort of repositioning as a result of that, because these big hedge funds have to do that, and that would very much explain the price action that we're seeing for risk generally, certainly relating to the S&P 500, the NASDAQ, and of course Bitcoin. And we're going to take a look at all of that, and I think that in itself very much explains what's going on right now with the markets. There's been this kind of repricing based on uncertainty taking place, and ultimately it's caused this like a little bit of a stall box for the markets. But once there's clarity on that, which I think we'll get in the coming weeks and months, my personal opinion based on everything that we're looking at technically and that 2017 scenario for the Dixie and thus the economy, ultimately sees a good time ahead. There is another camp to be in, and if you see there's more merit in there, it's likely you don't play the markets because they don't do too well under a recession. I don't think we're going to enter that. I'm in the other camp. I'm in the bullish camp. Based on everything we look at, there is a bearish camp out there, and perhaps the probabilities of that bearish scenario, at least in the short term, have increased somewhat. But I still think it's low. And we'll look at a kind of professional investors, sort of hedge fund managers' take on all of this. So first place for me to start. This is very relevant if you're a crypto investor because we are hypersensitive to that. We're higher beta. The first place for me to start is with what Scott Bessent had to say yesterday or a couple of days ago on CNBC. We're going to play a clip of Jerome Powell talking about the economy more broadly. We'll look at some data and then we'll relate that all to the charts and what we're seeing, and thus hopefully delivering an answer in regards to what's taking place right now. And everything that's happening with crypto has a hell of a lot more to do with the broader landscape of the markets than internally the cryptocurrency space, which I don't think has ever been in quite a bullish position as it is today. So let's dive into this clip of Scott Bessent. We played it yesterday, but we're going to play it again.
Top 10% of Americans are 40 or 50% of consumption, and that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down, and could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period.
And that detox period may indeed be somewhat of what we're going through, or that kind of readjusting, that calculating the formulas that go into these kind of economic forecasts, and thus a lot of hedge funds will kind of position or at least hedge from. It's very interesting. There is indeed a lot of data that's kind of perhaps brought somewhat of a not as clear picture to the table. Of course, we are seeing a bit of a resurgence in regards to inflation. However, it is still, in my opinion, pretty low down. If you look at true inflationary stats, which I think everybody likes to talk about true inflation, and I'm going to pull them up actually, but Trueflation now, you can see this is the US inflationary index. They've got this down at 1.4% and a real drop. It's interesting because true inflation would essentially say, look, this isn't an issue. However, in regards to CPI, there is a sort of rising CPI. We had non-farm payroll that came out on Friday. It is weakening, certainly in comparison. And the forecast for next month is already pretty low. So they're expecting continued weakening. Or the forecast for March, is pretty low, and that'll be given to us next month on the first Friday of next month. And also we had a slight resurgence in or an uptick in unemployment, which of course is correlated, unemployment at a high. So here markets would have been at a low and vice versa. And this is the kind of trend historically. So there is worsening economic data. On the back end of this, you've got people like Mohammed El-Arain, who's been in finance for a long time, essentially now reiterating a lot of what we just said at the start. And let's read this before we dive into a clip of Jerome Powell. Lower energy prices boost the purchasing power of consumers and reduce input costs for businesses. The administration's deregulation agenda could unleash a wave of corporate investment. And while the short-term disruption caused by Trump's trade policies are undeniable, the potential for long-term productivity gains through innovation in areas such as artificial intelligence, robotics, and life science should not be discounted. Similarly, if handled well, public sector reform could open the way for a more effective government operations and even provide some debt relief. Nevertheless, the balance of risk has shifted, what we're talking about at the start. It's just a matter of time until economic forecasts revise down their 2025 growth projections, which you've already seen, from the medium estimates of 2.3%, that's GDP, in February, from the Bloomberg survey in regards to what they're expecting this year, a downward revision of much as a full percent is not out of the question, raising concerns about how far the economy is from stall speed. While relatively low, and I agree with this, my probabilities of a recession has increased from 10% at the beginning of the year to 25 to 30% today. This is consequential and quite unsettling development for an economy with high potential and aspirations, elevated asset prices, and a pivotal role in driving global growth. And that, in my opinion, perfectly sums up what we're seeing with the S&P 500, which is the largest index in the world. Is it? I believe so. This is a global index, and you can see the kind of stall box. You've entered this kind of box period, which I'm certainly going to be paying a hell of a lot of attention to. The question on everybody's minds is, what's the resolve here? What ultimately is going to take place? Is there going to be a resolution to this? Are we going to continue higher like we have done on a number of occasions? We've dipped sort of below what I like to put on the charts, which is a 30-weekly moving average, a number of times, and had pullbacks, but ultimately have continued in the broader trend. And the question is this just a stall box based on this kind of readjustment in regards to or revision of the forecast economically, which of course has a bearing on stocks, US stocks certainly, which the S&P 500 is the index of, and everything else. And why the hell is all of this relevant to the crypto space? Well, it's obvious to many of you, certainly those of you that watch the channel regularly, but this is obviously Bitcoin and the S&P 500. They move, very much in sync, even in regards to the pullbacks. Yes, there's a bit of a delay, there's a bit of a kind of skewing, but you can see in regards to the recent one, and this really has everything to do with that data that's coming in. The question you need to ask, and will hopefully help you guys ask and answer, is what camp are you in? If you think that we're about to enter a dark, deep recession, and there could be a million and one catalysts, there always are. Markets always climb that wall of worry, in my opinion, or they do the majority of time. If you think we're entering this dark, deep recession, this data is only going to get worse, and we're going to see continued growth, and there's going to be a real nightmare take place, markets typically aren't going to do well under that context. If you think, and this is the camp I'm in, that we have economic growth ahead of us, and that's going to be based on a similar formula to what we saw Trump do in 2017 over here with the dollar. He ultimately weakened it. The same goes for interest rates. We've got very high monetary policy. We'll finish on a clip of Jerome Powell in just a second. If you think they're essentially going to induce economic activity through a lower dollar and lowering interest rates and an easing in monetary policy, which I think is to come. All we need is more certainty on that, which we don't have right now, despite Scott Bessent. I think that's why the dollar did this, sort of talking about their need or their want to lower interest rates for the bottom 50%. And that's something that they would like to do. Trump very much used the dollar to stimulate economic growth. I think they're going to do a similar thing today with the dollar, in our opinion, is coming down. And that, remember, assets are priced in dollars. So that should see, theoretically anyway, that should see assets do well. That's the camp I'm in, and there's this economic growth coming on the back end of that. And remember, technically, just to get rid of Bitcoin, certainly I think the cryptocurrency space, whether it's Bitcoin on its own merit, that has higher technical targets and is still in an uptrend, sees that continuation, whether it's the total 2, whether it's the total 2, total 3, others, wherever you look in the cryptocurrency space, I don't think it's a bad picture. These are ETPs that ultimately I believe are going higher, and they're a barometer for altcoins, really, even a big altcoin like Ethereum. I think this is just going to be a retest before continuation. So you're in two camps really at the moment. Let's now finish things off with a clip of Jerome Powell talking about the economy and talking about monetary policy and where they're at and what they're thinking in regards to it all.
I think that start with the general thought is that if there's a spike in prices that's a one-time thing that is going to go through the economy, then it's not appropriate to react to it, because our policy by design will reduce employment and activity, and it would not have really been needed to be done. So you look through those things if you can. So if you put that in the context of tariffs, I think if you look at where forecasts are, look at the blue chip, look where everybody's forecasting some inflation effect from tariffs. So it's very likely that if tariffs are imposed, and let's remember, we really don't know what's happening yet. We're at a stage where we're still very uncertain about what will be tariffed, for how long, at what level. We're going to have to wait to see all of that. But the likelihood is that some of that will find its way. It'll hit the exporters, the importers, the retailers, and to some extent the consumer.
To jump in there quickly, really you get exactly what we're saying here. Even Jerome Powell himself saying we're uncertain. Markets don't like that uncertainty. Again, by design right now, monetary policy is meant to, and it was brought about to sort of kill inflation off, weaken job growth, the economy generally. It's meant to sort of hold on to it, we're still very restrictive. The question is does that stay restrictive enough to see that tip over, that recession, that nightmare, that risk assets don't do well? Or is there that transition? And I think once we get clarity that rates are coming down, there's that transition that takes place. Let's finish things off with what Jerome Powell's saying, but really you get the uncertainty comments that we're making.
And we'll see what that is. And in a simple case where we know it's a one-time thing, the textbook would say look through it. But I think the situation, you would want to also be sure of a couple of things. One just is that if it turns into a series of things and it's more than that, and if the increases are larger, that would matter. And what really would matter is what's happening with longer term inflation expectations and how persistent are the inflationary effects. You want to look at all of those things, and you'd want to remember the current context, which is we came off of very high inflation, and we haven't fully returned to 2% on a sustainable basis. So you got to put all that in the mix as you make this decision. I would point people back to 2019, when we had the Tax Cuts and Jobs Act, we had lower immigration, and we had regulatory policy under President Trump in the first regime, and we wound up cutting 3 times because growth weakened so much. So there are many effects of tariffs. And as I pointed out, it's really the effect of all of these policies that matter for our policy. It's not simply what's happening with tariffs. It's what's happening with growth and all the other things as a result of these broad changes in economic policy, not just tariffs.
Okay, just to put a point on this, I think I know what you're going to say, but the usual rule that economists hold is that when an uncertainty is high, we're gradualist. And I'm wondering whether you view that as the right benchmark or anchor to think about.
I view it as the right benchmark or anchor for right now. And that's because the costs of the costs of being cautious are very, very low. You know, we're the economy's fine. It doesn't need us to do anything really, and so we can wait, and we should wait. I think there are cases where uncertainty is high, where that would not be the case, where the costs of going slow might be high, and those would be, for example, you know, if inflation expectations were clearly under pressure, or if you're at the beginning of the pandemic and uncertainty is unquestionably elevated, but you nonetheless act very aggressively because of the potential cost of not doing so.
So really all of this is relevant to us as crypto investors because we are just correlated to, of course, the economy, of course, risk more broadly. And just like Jerome Powell's saying there, just like Scott Bessent said, just like the economic data's sort of indicating, just like, you know, Mohammed is essentially saying, there's this kind of uncertainty. There's this increase on the back end of that uncertainty of the probabilities of a recession, something going wrong, i.e., and ultimately, you know, the markets will digest and act upon that until there's a revision of it, et cetera, et cetera, et cetera. You're in two camps. You're in the bull camp, which means the economy is going to do fine, and that's in line with global liquidity cycle, the camp we're on. Global liquidity cycles, business cycles, you know, debt refinance cycles, Bitcoin for you, all these cycles, and then technically we've got all the merit for it, and that's, you know, this kind of more orderly fashion. They start to bring rates down. It encourages growth. I think that's going to be a mandate of Trump's. Or you're in the, okay, we hold it too long. We get this continued worsening picture. And then ultimately, you know, the probabilities of a recession are imminent, and the markets essentially go into one and don't do well. You're either in one of those two camps. Act accordingly. Hopefully we can sort of be a little bit of a voice of reasoning, perhaps, or kind of overlay the picture. A bit of a longer daily market update, but I wanted to go through a bit of it because it's really what's plaguing the crypto markets right now. It's not about the disappointment on the back end of the White House summit, all of this stuff. In actual fact, all of this stuff is very bullish. That's it from me, guys. I'm going to love and leave you. Thanks for watching. See you all in the next one.